You're watching Business Incorporated live from Channels HQ. Coming up, gold exchange traded funds at Kenya stock market rose to the highest level since listing in 2017. Egypt signs $1.6 billion deals with China and EU companies to develop seaports. Plus, Brent and WTI headed for their biggest weekly fall since December as the banking crisis rocks global financial and oil markets. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how Iman is performing last trading day for the week. Let's start with the African continent. Now we see it's negative sentiment. Again, that's what we've been seeing this week. A lot of pressure on global equities markets. Now we see Nigeria there, 54,925 points. That's up 0.02%. Africa, South Africa there, 73,846 points. We're seeing a bit of recovery with the JSC there, even though it's been hammered this week. Today, we're seeing a recovery there. And EGX 30 down 0.14% to close yesterday. And we see Kenya again hammered again this week, down 3.44% for yesterday's close, 106.81. That's for the all-share index, hoping that 100 points actually holds going into next week. Let's look at the Middle East now. We're seeing the UAE. Those markets are trading at intraday, while Saudi and Qatari indexes thus are closed yesterday. And we see it's positive sentiment in the UAE with Abu Dhabi up 0.94% and Dubai index, that's up 1.20%. Convincing positive signs we're seeing there. But on the flip side, we see Saudi Arabia and Qatar closing down negative yesterday with the Qatari index, the biggest downer, down 2% to close for the week. Let's head on to Europe now, where it's all about rate hikes, with the ECB raising rates 50 basis points yesterday. Let's talk to Lars Holter right there in Berlin. Great to have you, Lars. So it's 50 basis points. I guess it was expected.
Well, it was a tricky situation the ECB found itself in. On the one side, they had long announced raising interest rates by 50 basis points. It was supposed to be the third such hike in as many meetings. The previous two hikes had been even steeper at 75 basis points. All these hikes, of course, were made in an effort to combat inflation across the EU. Raising interest rates is, of course, the strongest tool central banks have to do just that. However, now on the other side, rising interest rates had just led to problems with Silicon Valley Bank in the US. And even though all the banks that made headlines this past week are outside of the ECB's jurisdiction, because of course we're talking about US banks as well as Credit Suisse in Switzerland, some people were still afraid that rising rates could be problematic in the current environment and that the central bank should just take a break. But the ECB stayed its course, and that has a lot to do with trust. The ECB does not want to be seen as overreacting. They rather want to show steady leadership. And as always, the rate decision came with a more detailed statement. And in it, the ECB says that they are, quote, monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. With a look at banks' stability, they also write, quote, the euro area banking sector is resilient with strong capital and liquidity positions.
All right. React to the ECB staying its course.
Well, markets' reaction was positive throughout. Trading had been pretty weak leading up to the ECB decision, and then came an afternoon rally in Frankfurt, Paris, Madrid, also in London, although, of course, that's not ECB territory. Investors obviously not only reacting here to the interest rate decision itself, but also to the Council's outlook on inflation. The ECB projects inflation to average 5.3% this year, then 2.9% next year, and then down to 2.1% in 2025. Now, such a development would be a serious deceleration from the 9.2% inflation that the Eurozone saw last year, and that is definitely good news.
All right, Lars, so next week, the US Fed will have its own meeting on interest rates. What can we expect?
Well, probably the same as we saw from the ECB, which is sticking to the charted course. The Fed has announced a quarter-point hike, that's 25 basis points, and less of a hike that the ECB did, and they will likely go ahead with that as well. There's just too much of a risk in changing course. If the Fed would skip raising rates this month, it would send a message that they're unsure or don't place too much trust in the stability of their banking system. And that could create a panic on Wall Street. Fed Chief Jerome Powell and Treasury Secretary Janet Yellen both said over the past few days that they view the US banking system as sound. So going ahead with what they have already announced would just make sense.
All right, thank you so much. That was Lance Halter there, giving us the details from Europe. Now let's head on to the UK. We'll see Juliana standing by right there. Great to have you, Juliana, TGIF. But, you know, markets are on alert after US banks actually joined forces to rescue First Republic. What are the reactions? What reactions are we getting in the UK about this?
Well, I think, good afternoon, Laddie, TGIF. I think the stress and vulnerabilities of the banking system are on full display. It was just 24 hours ago. We were talking about the fallout of Credit Suisse, and we said, look, is there more to come? There is more to come. There has been more. And now it's First Republic Bank. They've been loaned $30 billion, led by a consortium of Wall Street's biggest banks, including JP Morgan and Chase and Bank of America. And that's because, you know, the whispering has now turned into a firestorm. If you think about it, it was just literally 7 days ago that we had the announcement of the crisis in Silicon Valley Bank that led to the collapse of two other US banks. And then over the weekend, the Bank of England and the Treasury had to intervene to try and push HSBC to buy the subsidiary. And then it's all tumbling across. I think there are concerns. Of course, there are concerns, because it does still give some nausea to what happened 15 years ago at the beginning of the 2008 financial crisis. But it does appear as if central bankers who weren't involved, the US Federal Reserve weren't involved in the Federal Republic Bank bailout, but they certainly were putting pressure on the consortium to do something. But it does appear as if central banks around the world are now realizing that they've got to act quickly, they've got to act rapidly, and then it allows it to stay within its borders and not leak into a global financial crisis. But, you know, there are some concerns. I think if you look at the Federal Republic Bank, the problem that they were having is that people were taking out their money quickly, and those discussions are still ongoing. So as I was saying yesterday this time, Laddie, that we couldn't be too confident that there wouldn't be another fallout, and there was. I'm certain that over the weekend there are going to be more of this. In fact, I think when Janet Yellen was speaking in front of Congress members just yesterday, she revealed that, you know, within the past 7 days, the amount of money that the Federal Reserve has had to borrow to banks has reached $155 billion. If you compare that to where we were this time last week, it was $15 billion. So certainly there is some moving and shaking, but I think economists are trying to keep a tight lip, because of course it's that rapid news fire. As soon as one person hears something, people start moving and people start taking their money out. So let's just wait and see. But I think for now, the UK Bank of England and the Treasury are slightly assured at the fact that it doesn't appear as if this latest issue is going to affect UK banks, but never say never.
Yeah, never say never. And I wonder what other black swan events could come later on. But let's talk football now. I know you and I were Manchester United fans, and let's talk about the takeover now. See Sheikh Jassim expected to make a second bid for the club within 10 days. What are you hearing about this?
Yes. Let's talk about my favourite topic, shall we? Football, not my favourite topic, but of course I do love talking about Manchester United. Yes, we are both fans. Let me make sure I get his name right. Sheikh Jassim bin Hamad Al Thani.
Oh, yeah.
He is a billionaire Qatari. the son of the former leader of Qatar. Now, he is in the hot seat and the top spot to take over Manchester United, who wouldn't want to take it over. They do have lots of bidders, but of course the Qataris are number one. They put in a bid, I believe it was a couple of days ago, for about £4.4 billion for the Glazer family who own the club, pretty controversially. The Manchester United supporters have never been happy with them, and their popularity has been dipping swiftly. They said 4.4 not enough. They want £6 billion, even though Manchester United isn't worth £4.4 billion, according to economists, but it is a trophy asset, right? Who doesn't want to own one of the world's most popular football clubs? So they are going to be putting in another bid. In fact, yesterday, I think the Qataris sent quite a large delegation to Old Trafford. They were given a tour of the stadium. I think they also went to Carrington, which is where the players play. They had lunch there. It seemed to have been a very, very good 10-hour meeting, but they're not the only ones. There's also a local team. I believe the consortium is called Ineos. It's led by some local millionaires within Manchester, because one of the huge issues we've been having in the UK about the ownership of Premier League football clubs is some English people want, these clubs to stay pretty much English, but of course they can't stay English if they can't afford them, which is why the Qataris seem to be the top bidders. I think they've got about 10 days to put in a second bid, but considering they did have a very successful 10-hour-long meeting yesterday, it does appear as if that bid is likely to come through, possibly even as early as today.
Possibly. We're looking out for that, and hopefully we get back to winning ways. Let's talk about Man U there. But how the markets ending the week at intraday?
Yeah, it's been a topsy-turvy week, hasn't it? Early this week, the blue chip index lost £78 billion worth of its market value because of the fallout of the SVB banking crisis. It's gained something back, but there were some falls this morning from highs earlier. The FTSE All-Share is up 0.43% at intraday. The FTSE 100 is up by 0.47%. And the FTSE 250, the domestic market, is up by 0.20%. In the currencies market, the British pound is trading up against the US dollar by 0.20%, although down against the euro by 0.02%, but up against the Japanese yen by 0.06%, Laddie.
All right, Juliana, thank you so much for the update. We'll see you next week. Enjoy the weekend.
You too, thank you.
All right, now let's take a look at what's happening with U.S. markets. Now, we see futures tied to the Dow Jones Industrial Average fell as investors contemplated the future of First Republic and other banks. You see Dow futures, that dipped by 144 points there. See behind me, it's red, 0.87%. And we see the S&P 500 marginally down for the futures market, 0.06%. We see the NASDAQ, the tech-heavy NASDAQ, that's up 0.06%. Let's get a summary of yesterday's close from our correspondent, Maria Bird.
The U.S. stock market rallied on Thursday as 11 major U.S. banks injected over $30 billion into First Republic Bank, trying to ward off what happened last Wednesday when several U.S. banks went into failure. It is clear that investors are trusting the banks and believing that the U.S. economy could be on an upswing. As the Dow Jones closed at 1.2% up, the S&P 500 closed at 1.7% up, and the heavy tech NASDAQ gained at 2.5%. It is clear that investors are hopeful that the banks will be able to ward off any signs of a recession.
All right, that was our correspondent there, Maria Bird, giving us yesterday's summary. So we'll take a break now. When we come back, we'll take a look at how digital lending platforms are handling all the rate hikes and supporting MSMEs in Africa. That's our next conversation. Do stay with us. Welcome back. Still watching Business Incorporated live from Channels HQ. To our next conversation now with about 100 million MSMEs in Africa and Nigeria boasting of about 42 million. How the digital lending platforms managing to serve with rate hikes and banking sector liquidity issues? Let's talk to Laureen Nabuko-Haney now, CEO and co-founder of Fair Money, join us via Zoom in Paris. Great to have you.
Yeah, hey Larry, good to meet you. Thank you.
So yeah, with the recent rate hikes, that started last year. Now we got the ECB yesterday raising by 50 basis points. Expectations that the Fed would also raise again. We don't know by how much, maybe 25 or 50. How's this impacting, digital lending platforms in Africa?
Yeah, I think for our case, I would largely speak for Nigeria now. So you'd see that, of course, the Fed and the ECB increasing their rates has a direct impact on lenders. We at Fair Money, we are mainly or only focused on the Nigerian markets, and here also we've seen several interest rate hikes. Now to understand the impact that interest rate hikes have on lenders, digital lenders, or even banks, it's important to understand what that does to an economy. So if the interest rate is increased by the central bank, what you'd see as a direct impact of that is that prices increase, right? So we've seen in Nigeria prices increase, and prices increase basically across board. Everything is getting more expensive. What that does is, if things are getting more expensive, the average consumer has less money, more pressure exists on the average spending habit that the customer has. So the average consumer has less money. If the average consumer has less money, it does two things. So of course, as a lender, that might lead to increased demand for credit. But on the other hand, it also creates more pressure on the on the financial health that the customer has. So it really has a variety of impacts. On the one hand, you really need to manage your risk much better, and that is in Nigeria, that is across Africa, that is even in the US. In the US, for example, we've seen that credit card defaults have been on the rise since the Fed has increased the rates. In Nigeria, I've seen that much less yet. But on the other hand, it also means opportunity. If you provide a responsible credit solution for customers, now might be the time that the customer needs support on their cash flow. And that is really across retail, and that is also across the SME sector. So when we think at Fair Money, when we think about interest rate increases, we really think of it as number one, a challenge for our risk management strategies. We need to be on top of it. We need to understand that there's pressure on the average consumer. But on the other hand, it also means opportunity as the consumer on the retail end or the SME customer might need more support from its bank, from banks like us, to provide them with cash flow solutions.
And talking about pressure to the consumer, the arguments that the digital lending platforms have really, really high rates, and I'm wondering, will there be a point or a time where the digital lenders, their rates are actually quite affordable?
Yeah, no, it's a good question. I'd say though, so from having a good overview of the market in the last couple of years, you'd see that bigger players in the digital lending space, and that is across Nigeria, but also across Africa and even beyond. What we see nowadays is that if you want to be competitive as a lender, right, and if you don't want adverse selection, and you don't want adverse selection as a lender, what you need to do is you need to decrease your price over time. So you really need to be able to provide the customer with competitive rates. If the customer have competitive rates, you start referring you, he will pay you better, or she will pay you better. And that is really what we're seeing. The higher the rates, potentially the more the adverse selection is too. So any good lender or any large lender has a very strong incentive, to work on rates and decrease rates over time in order to attract a lower risk population. And clearly we've seen that, and we've seen that for Fair Money, we've seen that for other lenders. The overall trend in the industry is actually a decrease in rates as underwriting gets more sophisticated, as it gets more competitive, as lenders are competing for the lower risk customers. But yes, of course, you also need to, as a lender, you also need to see the environment that you're operating in, and interest rates, and sort of what the central bank does has a direct impact on interest rates. Yeah, we can't deny that.
What would you say is the impact of digital lending platforms on MSMEs right here in Nigeria?
Yeah, look, it's huge, right? I think so. Maybe to take a step back, what we're trying to achieve at Fair Money is really we're trying to rebuild and build Africa's money story. So we are trying to impact and write the story about money in Africa, how people are thinking about Africa and how people are thinking about Nigeria. And we want people outside of Africa to think about Africa when it's about financial innovation, financial service innovation, fintech, and how advanced we are in dealing with money and spending money in products that help us manage our money. And I think Nigeria is really at the forefront today, and the average consumer can feel it, right? And let me give you a few examples. So if you today look at the, specifically about the credit business, but I'll talk about the payments business after. If you look today at the different players that are giving credit in the society in Nigeria, and if you look really at the number of credit facilities that are today given by digital lenders, it's huge actually. So I mean, for Fair Money, in terms of numbers of credit facilities, we are number 4 in Nigeria now compared with all other banks. So you'd see we've reached some scale, and a few other digital players are also on the rise. So you can see that the way and the transformation which we're in, I think it's a very, very big transformation, and the average consumer in Nigeria can feel it, can use products like Fair Money in their daily lives and borrow from us, but also make payments with us, use our debit card product, and so on and so forth. So that's really on the sort of banking side. If you talk about payments specifically, and I'm sure you guys spoke here on Channel TV about this. The payments space is quite large, and it includes, for example, online payments. When you can make a payment with your card online, you can order things, you can pay things, and that is all with the payment infrastructure that has been developed over time. You can use an agent bank, you can pay with your debit card in a store. All of those payments that the retail customer makes today, they're all riding on part of this technology that were developed over the last 5 to 10 years. So I'd say technology in Nigeria helps to make the average person's life better, more efficient, cheaper. It helps us to rewrite a bit the way people think about Nigeria and Africa as a whole. And there's a big opportunity for us to be at the forefront of innovation today and in the next couple of years.
All right, but before I let you go now, looking at, that whole industry, what kind of, innovations, can we expect, partnerships to, get the rates cheaper, get more MSMEs, supported, and, just, build that industry to be more resilient, going forward?
Yeah, I mean, I think that what we are going to see, and we've started to see that recently, is definitely two things. Of course, continued innovation, building new products, but also we'd see companies joining forces. So, for example, Fair Money, we just bought one of the larger merchant acquirers in Nigeria. So a business called Payforce, they help the smaller merchants to accept payments. And make the life of the average business person in Nigeria simpler, easier, and help them basically to make money, manage their money better. And this kind of consolidation we'll see a lot. I think as the ecosystem will mature, the bigger players will start to merge with the smaller players, and all of that, in my opinion, I'm very convinced by that, is going to help the end consumer and the small businesses, to manage money easier, manage money better, save money, and really enjoy the fruits of this innovation wave that we're currently riding on. The end benefit, the person benefiting in the end is always going to be the end consumer, and small and medium enterprise in Nigeria.
All right, let's hope the rates get more affordable as time goes on. Thank you so much, Lauren Haney, CEO and co-founder of Fair Money. Thank you so much.
Thanks, Ali. Thanks.
All right, now let's look at other stories on the African continent. Now we see gold exchange traded funds at Kenya's stock market, that was yesterday, rose to the highest level since listing in 2017, offering investors access to global yellow metal markets in local currency. Investors at the Nairobi Securities Exchange can buy the listed for about 400,000 gold bullion debentures, each equivalent to 0.01 an ounce of gold. The price of the new gold ETF rose to about 2,606 shillings at the close of trade yesterday and Wednesday, and starting the year at a premium. Metal rose to its highest since early February. The rising global gold prices follows troubles at Swiss lender Credit Suisse amid renewed fears of a banking crisis worldwide that steered traders towards the safe haven metal. And Egypt's Suez Canal Authority have signed development agreements worth $1.6 billion with Chinese and European companies. The deal comes as the government is seeking to use its ports to boost the economy. The General Authority for the Suez Canal Economy Zone signed an agreement to develop and manage the container terminal in the Sokna port and Red Sea with Hong Kong-based Hudson Ports and French shipping company CMA CGM and the Chinese state-owned COSCO Shipping. Egypt's state-owned port also alluded to this, and the authorities signed a second agreement to develop the Dikela port near Alexandria on the Mediterranean with Hudson Ports and the Switzerland-based Mediterranean company shipping. That's a shipping company right there in Egypt. All right, so those are the stories making the headlines, and that's how your money performed at intraday. It's been a tough week for global equities markets. We'll see how next week actually pans out. Thank you so much for watching. I'm Ladi Williams. Bye for now.